A major market level just broke. Institutional capital is rotating out of the tech sector, leaving the indices without their primary drivers. The question for the weeks ahead is whether this breakdown is a standard buyable dip or the start of a larger structural collapse. The SPY index is sitting exactly on its 200-day moving average. Historically, the last 3 touches here triggered reliable price rebounds. With RSI already oversold and the total drop at percent, data suggests an exhaustion point rather than a full market crash. While a relief bounce toward the 665 area is a likely scenario, the current downward trend means traders should remain cautious rather than looking to buy every move. The caution becomes clearer when we look at the Nasdaq. The QQQ index is currently the epicenter of the market's weakness. Unlike the broader market, the QQQ failed to hold its 200-day moving average, dropping through support without hesitation. Zooming in reveals a lack of bounce at this intersection. Market makers are hesitating, showing no signs of aggressive buying in growth stocks. Until the QQQ can reclaim this threshold, the internal structure of the tech sector lacks a stable support base, making it difficult to trust as a leader for a broader recovery. Small caps are now the final pillar holding their ground. The IWM index is the last major index that hasn't given up its long-term trend line. This chart shows the IWM rest on its own 200-day moving average. It is a binary setup. The index will either provide the support needed for a short-term market bounce or break down toward the next target at 227. Because of this positioning, the IWM is acting as the decision engine for the market's next directional move. To understand the risk, we have to look past the indices to the driver of this instability, the VIX. The VIX recently moved up 18%, placing it in the elevated zone between 25 and 28. Volatility levels over 25 typically indicate an unstable market. When the VIX crosses 28, the risk of rapid, unpredictable price swings increases significantly. The March 20 triple expiry event adds a layer of complexity to this volatility. The collision of monthly, quarterly, and weekly options often leads to erratic price swings and position reshuffling that can obscure the true trend. Until the VIX stabilizes below 25, upward price movements occur in an unstable environment. This makes it difficult to distinguish a sustainable reversal from a temporary bounce that may fade as positions are adjusted. Looking outside traditional stocks, alternative assets are also showing signs of the broader rotation. Gold is currently pulling back after a significant run. This chart identifies 2 potential entry points. The first accumulation zone sits between 398 and 493, while a deeper, stronger support level waits at 370. Bitcoin is also in a period of consolidation. Rather than breaking out, it is currently moving within a narrow range. The current channel for Bitcoin is tight, support at 74K and resistance at 76K. If it loses the 74K level, there is a significant risk of a drop towards 68K. Chinese markets, represented by the FXI, are still showing structural weakness. They remain without clear support until they reach the 30 level. The lack of clean entries across these assets suggests that waiting for confirmed structural breakouts offers a higher probability of success than chasing price. The market is held by 4 conflicting signals: SPY at support, QQQ showing weakness, IWM pending a decision, and the VIX in the danger zone. While a relief bounce is a high probability event, entering now requires going against the broader downward momentum of the tech sector. Right now, the current market structure is fundamentally fragile. The most reliable approach is to protect capital and wait for technical confirmation before committing to any new trend.